introducing
you. Yeah, sir. Yes, sir. I'll just start the recording and I'll start.
Yeah, please.
Yeah, a very good evening, cheerful evening to you all gathered here. So I welcome you all for the webinar series of VMS Vayomanasa Sanjeevani. So we are successfully running of 161st webinar today. So on this grateful occasion, I welcome Mr. Samit Shankar Shetty, who is a great expert and entrepreneur, and he is like board member and advisor in various multiple organizations, and he's an expert. We have our expert today to talk on a topic, managing finances in later life. So with no wasting time, I welcome you all, and I welcome Mr. Jambunathan sir, who is an active senior citizen, an active VMS volunteer, and who is there with us to moderate the session today. I also deeply from my heart welcome all the YouTube and Zoom participants for this session today. So I hand over the session to Mr. Jambunathan sir. Please, sir.
Thank you very much, ma'am. It's my pleasure to talk to all of you today. Namaste and good evening to Mr. Samit Shankar Shetty, coordinator of this program, resource person of this program, today's program, Mrs. Arnapurni, students, staff and volunteers in NIMHANS, the viewers and participants for this webinar from across the country and other parts of the world as well. I have great pleasure in welcoming you to yet another edition of the fortnightly seminar being thoughtfully organized by Vayomanasa Sanjeevani, an outreach arm of Geriatric Department of NIMHANS, Bangalore. All of us are aware of the importance of a nice and a good bank balance at all times of our life, especially at our old age. A nice bank balance always keeps us happy. So, in this context, I'm happy to introduce Mr. Samit Shankar Shetty, resource person of this evening, who has kindly agreed to enlighten us on the important topic of managing finance in later part of life. Mr. Samit Shankar Shetty had his graduation in engineering faculty from Bangalore University. He has obtained his master's in business administration (MBA) from the most prestigious Indian Institute of Management (IIM) Ahmedabad. He is currently the CEO and managing director of Navi Fin Service, which is the NBFC subsidiary of Navi Technologies, and he works in personal and home finance through mobile apps. Navi Finance Service has now an asset base of 5,000 crores. Samit is an entrepreneur, investor, and board member and advisor in multiple organizations. His specific focus is on business with services and products that impact the low middle income population. Currently, he is a non-executive director of boards of Chaitanya India Finance Credit, NBFC MFI, Indus Momentous Business Solutions, and Plan Visage. These firms are IT solution providers and the consultants in the supply chain of business management. He is an independent director on the boards of NBFCs, Quadrillion Finance Private Limited, and Borrow Space Capital Private Limited. He has also promoted a new firm, Alphans Solutions Private Limited, to promote innovations in healthcare and natural farming. He is an avid early stage investor with investments in multiple funds and startups. He is a trustee with Nivas Trust, a not-for-profit organization, which provides currently sensitive site-drawn design interventions in the housing for the low-income group. He volunteers with Yoga Kshema rehabilitation, and wellness centers. We feel that we are fortunate to hear and be benefited from your varied knowledge in finance, especially in our old age, about the best way to manage our finance, which is the important aspect of active aging. Sir, kindly go ahead with your presentation. Thanks for your participation, sir. Thank you very much, sir.
Thank you, Mr. Jambunathan, for introducing me, and my thanks and regards to Vayomanasa Sanjeevani Group, also to Dr. Vijay Kumar, who's a batchmate and a dear friend of mine. Yogakshema, which I'm a part of, I'm a volunteer in, has associated in the past with Vayomanasa.
Sir, I think you are cut off. Sir? Samish, sir?
Can you hear me now?
Yeah, I'm hearing you, sir. Please,
Yeah,
sir.
sorry. I think there's a power drop.
Yeah, there was a yes, sir. Go ahead, sir, please.
So I've been associated with Yogakshema, which has a past association with Vayomanasa Sanjeevani. We edited one of the books that came out in context of this. Dr. Usha Vastare, who's the founder of Yogakshema, has a lot of work with Dr. Shiv Kumar. So just to set the context for the session, and feel free to interrupt.
I think again there is internet is playing here, hide and seek, sir.
I request all the participants to mute yourself.
I think, Madam Naveen Sab has, Samir Shab has been disconnected.
Yeah, there is a network issue from his side. So we'll wait for another few minutes.
Yes, ma'am. Yes.
Participants, please be patient. There is an inconvenience in the network issue. The resource person will join within a minutes. Please bear with the inconvenience.
In fact, I am trying to reach him on mobile. Can you
I'm really sorry. I think I seem to have a power outage 2 times. If you could just put me back as host, I'll.
Sure, sir. Yes, sir, done.
Yeah. So I don't know how much you were able to hear, but broadly, I'm treating this next 45 minutes as an opportunity to advise people of my parents' age group. My father is 78 and my mother is 73. My father continues to do a little bit of a legal practice. And I'm advising this more. I'm not a fund advisor. I'm not a insurance expert. I'm largely, my education is in finance. My learning has been in my MBA and as I work and as I managed my own investments. So I will probably take 15 minutes of presentation, and from then on, I will very quickly move on into the actual crux of the presentation. So let me just, I will cover 4 broad aspects. I hope it's of utility for all of you. I will quickly cover taxation without making it too long. I'll cover investments, and investments I'm going to cover 2 parts, which is fixed returns and annuity, and what is called as systematic withdrawal plans. The third piece I will cover is insurance and inheritance. The fourth is really advisory. Like I said, please treat it like advice from a son to a father. My advice is very simple and straightforward, and this is exactly what I tell my father. But only difference is with parents, they may not entirely listen to you. So that's a longer conversation. I'm hoping with you guys, it will be a shorter conversation. Then I have some questions. Mr. Jammunathan has been kind enough to share some questions. I have used some of those questions as a quick FAQ. So these are the broad 5 aspects that I'll cover. So let me quickly, in the interest of time, get on to the first point, right? So the first suggestion for everybody, especially in the elderly age group, is since you're managing your income through interest, right, and interest coming from investments, it is always good to manage it for have separate income streams for both spouses. You have to realize that unless you go into the methodology of having Hindu undivided families, etc., it is both of you will be taxed separately. And today in India, under the new income tax scheme, and even under the old scheme, income almost up to 7.5 lakhs, or at least 7 lakhs for sure, and close to 14 lakhs can be managed tax-free. The reason for this is under the new scheme, 25,000 rupees, there's a tax rebate that is being given. So first 3 lakhs is anyway free, 50,000 with standard deduction. And on the next, 2 lakhs and the 2 lakhs after that, the total tax comes to 25,000. That is why up to 7.5 lakhs of income is treated as tax-free for every individual. So potentially, if there are 2 partners, you could have tax-free income for close to 15 lakhs. And I'm assuming that if your income is entirely from interest or pension, ideally use the same bank for your fixed deposits. Wherever you're getting pension, use the same bank for fixed deposits, because this will avoid filing tax returns. You can use your bank now to file tax returns. And whether you use your bank to file tax returns or not, if your income is only from interest and pension, please file the Form 15H. You should go to your bank and ask them for a Form 15H. Once you file the Form 15H, they will not deduct TDS. As long as you can declare that your income is below 7 lakhs, they will not deduct TDS, and you will get the entire interest in your account. If you don't file 15H, you will have a TDS, and then you have to claim it back from the income tax. Right? If there are no questions on this, I will just move forward. On the old tax regime, while this 25,000 rebate is not available, in the old tax regime, you can claim payments against health insurance up to 50,000 rupees. If you have medical expenses, you can claim 50,000 rupees. If you pay rent, you can claim for interest income up to 50,000 rupees. So effectively, whether you're using the old scheme or new scheme, you are broadly not going to have any taxation up to, as a husband and wife together, up to 14 lakhs, as individual up to 7.5 lakhs. Now, another small piece of advice: a lot of children do support their parents, and they are tax-paying citizens. One of the interesting ways to do this is if children invest on behalf of their parents in the small scheme, and they can make themselves nominees so that in the later part they can get the money back, but the interest then goes to the parents, and essentially the funder, who is the child, can save any tax outflow in this regard. Right, this is broadly on taxation. I will quickly move to the next and probably what is the most important part of what I'm going to discuss. So the standard question I get, and this is the question, like I told, even my father wants to know, everybody wants to know, is what is the kind of investments I should make, right? How should I manage? Because there is all this, a lot of fascination about equities and stock markets, angel investing. So everybody gets excited that what are the investments that I could make? I will say there is a very simple thumb rule, which works well in finance up to the age of 50. Right, at 20 to 50, I will say predominantly put it in equity. And when I mean equity, I mean highly volatile and long-term assets with very little yield. If you know equity does not earn dividend. Yield is next to nothing, right? And I'm defining yield as what is interest. What when you put some capital, what is that you earn on that capital? That is called yield, right? So there are assets like equities that earn on appreciation. They don't earn much interest or much yield. So when you're very young, up to 50, I would say 100% in equity. 50 to 60, I will say 25% into assets that earn a monthly or a yearly return, which is called yield, right? And maybe 75% or up to 50% till the age of 60 in equity. Beyond 60 to 75, I will say you keep less than 25% in any asset that is for capital generation. So I'm separating assets into two buckets: assets that earn interest, assets that earn interest and capital generation. So by the time you hit 80, you should have 100% of your assets earning interest income, earning what is called as yield, interest or interest kind of income. Anything that is earning income on a regular basis, let's call it yield, right? So what should be my corpus, right? What should be my corpus to ensure that I have that's a standard question I get. Do I have enough money to, costs are going up? Do I have enough money to retire? Is my corpus enough? We will address the question, what if I don't have the enough corpus? But what is the right corpus, right? So if your monthly running expense is 20,000 rupees, right? I would say a corpus of close to 200 to 250 times of around 50 lakhs is what you need to ensure that as the cost of living grows, your corpus will keep pace with inflation. So typically the way you do in finance is, if you have 100 rupees and you earn 8 rupees, 4 rupees is spent, other 4 rupees goes back into your corpus so that the corpus grows and it earns interest on a higher amount, so that as the cost of living goes up over time, you will earn more and more interest so that the interest income will keep pace with the cost of living, right? So a good rule of thumb is, if I have a corpus of 20 lakhs, I should not have a monthly running expense of more than 0.5%. 0.5% of 20 lakhs is 10,000 rupees, right? So if I have a corpus of around 40 lakhs, I should not have a monthly expense of more than 20,000 rupees, right? And this is really the way you manage, because we are all living longer lifespans, right? As your age grows, your corpus can get a little low. So they can come down to as low as 120 times, because as age grows, expenses come down. One, lifestyle expenses come down. Second, the remaining lifespan automatically is expected to be lesser. So your requirement to build the corpus goes down and you can start consuming a little bit of your corpus, right? So ideally, when you are at 60, you start with 300 times your current running expenses as your corpus. And over the course of time, you will draw down your corpus little by little. And as you cross 85, 90 years, your corpus will probably be only 100 times your 100 to 120 times your monthly running expense. Now, there is a question, on how do I manage emergencies? Ideally, the corpus should take care, interest on the corpus, which is 0.4 or 0.5%. Your interest will probably be double that, but 0.4% of the corpus should take care of all your monthly running expense. and some of the corpus will go back, some of the interest will go back into growing the corpus. And at some times, as you will have emergencies, you may have to draw down from the corpus. So that cushion is there if you have 250 times your monthly expenses, your corpus, to draw down from the corpus in the case of an emergency. Right now, as we are speaking today, what are the standard investment plans or the good investment options that exist? The government had a pension scheme, which currently is, I think, expired in 2023. So the current best option that is available is small savings, senior citizens savings scheme, which earns 8.2%. Which the good thing about it's not that the 8.2% is high. The good thing is the 8.2% is an interest that is assured for you over the next 5 years. It is paid every 3 months, so it can be used like a monthly expense. So as a good thumb rule, they're allowing you to do up to 30 lakhs each person. So husband and wife can do much more. So at 30 lakhs, you're probably going to earn 20,000 rupees every month or 60,000 rupees in every quarter. And a husband and wife both can do that investment. Other than the senior citizen savings scheme, the next best plan, which is very commonly available, and it is available from a lot of insurers. I can give the names of the insurers that is available, which is called as annuity plans from insurers, right? Annuity plans typically is available as joint life plans, which the couple can take without return of purchase. It means that the corpus that you invest in this plan will not be returned to anybody. So they will consume the corpus, and the insurance company is taking a little bit of a risk on the lifespan of the person. And of course, there are some people with shorter lifespans and some people with longer lifespans, but they take that risk and they do this joint life plan without return of purchase. And usually you get a 9% annual yield, right, with a monthly payout. Aditya Birla has this, ICICI Bank has this, SBI has this, so you can pick any of the insurance companies that have what is called as annuity plan with a joint life plan without return on purchase. The third best option, according to me right now, is FDs from banks for senior citizens. Please don't choose any of the cooperative banks. Ensure that it can be a private bank, but ensure that it's a bank governed by the RBI. I would not recommend anybody in the current stage to do long-term FDs. Try and do it for 1 to 2 years. Currently, the 1 to 2 year interest rate is above 8%. Ideally, unless the long-term interest rate, that is a 5-year interest rate that the bank offers, goes above 8.5%, don't do long-term. Do for 1 to 2 years. It gives you the flexibility of liquidity. It gives you the benefit of having access to that money. It also gives the benefit that if the interest rate goes up, you can reinvest at a higher interest. Right? Just to kind of complete this session on how to manage my investments. Now, the fourth option, especially for people who are slightly younger, in the age group, let's say 60, 65, who think that they have another 20, 25 years to plan. My recommendation is, like I said, I said 100%. Yeah. May I request? Sure. Yeah. Probably. Yeah. So for people at the age group of, let's say, between 60 to 75, there is still some merit in keeping some proportion of your money, what are called as balanced advantage funds. May I request everybody to mute unless they are.
Yeah. See, Mr. Gopal, and then Gopal.
I think.
Yes, muted, sir.
So for people who are in the age group of 60 to 75, I think after 80, I would recommend everybody to go into fixed income, completely fixed income. But till your age of 60 to 75, why should you choose equity? The reason to choose equity is that it gives you a slightly higher return. It can be very volatile, but at this age, you can handle the volatility, right? So do either some amount of, at least 25% in an equity mutual fund, or do around 50% in what is called as a balance fund. Balance fund invests a mix of equity and debt. And most of the good mutual fund houses have these options, right? So I have listed the mutual fund houses. I have no specific preference for them. I think they're all good. whenever you invest in mutual funds and insurance companies, my request is go directly to their offices. If you can do it online these days, there is a mandate to have direct mutual fund. All mutual funds have options to do it online, but if you cannot do it online, visit their offices. Most of these mutual fund have offices in the major cities of India, and most of the insurance companies have offices in the major cities of India, and you can do that offline also. The last piece of information that I want to leave with you is there is something called a systemic withdrawal plan in most balanced advantages fund. The advantage of a systemic withdrawal plan is it's opposite of a systemic investment plan. So after a certain age, between 60 to 80, where you want to benefit from the upside of equity, that you want some of your investments to sit in a balanced fund with some equity, try and invest in such a way that you can withdraw 0.5% every month, right? And as you go closer to 80, you can withdraw 1% of the corpus every month. So this is a standard scheme that's available with every mutual fund. It's called a systematic withdrawal plan, or an SWP. And in this scheme, let's say you invest 10 lakhs, they'll allow you to withdraw a fixed amount every month. So that amount will keep coming to you and it will be deducted from your mutual fund units. I am trying to go to the next. Yeah. So now the other question that commonly asks is, what do I do if I do not have a corpus? And I'll keep this very simple. There is a trade-off between returns of assets and appreciation of assets. So assets, any asset gives return in two ways. Either the asset appreciates or it gives a yield. Yield is like an interest, right? So there are some assets that give very low yield. A good example is land. Land gives zero yield. Gold gives very little return on a monthly basis. Some of them are low liquidity, some of them are high liquidity. So any asset that gives low yield and low liquidity will also give high capital appreciation, which is why land gives a very high appreciation over long durations of time. The opposite is also true. Any asset that gives you good high yield, or any asset that has no appreciation, will usually give you high yield and will be very liquid. So as you age, the higher your age, the more you should move to higher yield and lower appreciation assets. So broadly, you have to think of assets that when I am aging, I move to assets that don't give me capital appreciation, because I'm not looking for capital appreciation. I'm looking for a income from my assets, right? So when you don't have a corpus, what you should try and do is move out of assets which are by nature assets that give appreciation, right? So one of the classical assets that give appreciation is land, right? Apartments, they give appreciation, but they give very little. Rental yields are 2-3%. That's all, not more than that. If you have things like cars, vehicles, they don't give you appreciation. You are better off renting these vehicles. You should try and move out of assets like gold and silver as you age, because these assets are very good assets for the long term. But as you age, assets that earn yield, assets that earn an income is far more important. And if you're a businessman and you have investments in business and enterprises where you have to reinvest money into the business, some businesses give out monthly cash, but a lot of businesses, the money comes in growth. You have to keep investing in the business and the business grows. It is a good time to reduce your exposure in a lot of these investments. So how do I build a corpus? Building the corpus is usually by getting rid of assets that give me appreciation, are high on appreciation and low on interest. So you have to move your asset portfolio as you age from assets that are low. You have to move it into assets that are low on appreciation or may not appreciate at all, but will give me a high return on my interest. So the next, I'm getting down to emergencies and we will wrap up very quickly. How do I manage emergencies, right? So for most of us from the middle income, if you have some amount of savings and some amount of some insurance plans, one of the things I always recommend is opt for what is called as super top-up plans. Every insurance company gives super top-up plans. The super top-up plan in insurance is basically the insurance company will not cover the first 1 to 2 lakhs of hospitalization, but they will cover after that. Why you need a super top-up plan? Because sometimes there could be very extreme events which cost a lot. So super top-up plans will cover from 2 lakhs to 20 lakhs, 2 lakhs to 50 lakhs, depending on what you opt for. So super top-up plans are one of the best things for very large expense outflows. If it is small outflows, your insurance takes care. Ensure that you take up a super top-up plan in case of very large outflows. People who don't have insurance and are at a very high age group, honestly, there are very few options, but one of the options provided to public sector insurance companies, which is National Insurance Company and New India Insurance, has senior citizen mediclaim policy, which goes up sometimes above 80 plus, depending on the time they will provide it. Sometimes they don't. I have seen them provide even up to 80. Some of the private insurances are today open up to 75. Opt for these plans. Of course, they will not allow for pre-existing illnesses, but it is still better to have an insurance plan. Even after that, if I have an emergency, what do I do, right? I don't have an insurance, or I have some form of emergency. What do I do? One of the options is to liquidate your assets, especially give your assets to somebody who's near to you, family members, and ensure that you get liquidity against that. And you are essentially trading your asset that you have in exchange of, sometimes your asset could be part of an inheritance for your family. You're trading that asset or that inheritance that you have with your family and creating a liquidity support for yourself. If you don't have insurance and there is an emergency, one of the best options is to, instead of selling the asset, trade that asset to somebody who's a potential inheritor in exchange for some liquidity support. Because a lot of times, if a younger person holds the asset, banks are willing to give mortgage on the asset, so you will get the liquidity support, and what is an inheritance of after a lifetime can become a liquidity support for you in the short term. In spite of all of this, if you still don't have enough funds to handle your emergency, I will say bring down your liquidity corpus, right? So if your liquidity corpus becomes lesser, be aware that your monthly expenses also have to come down. At least at the age from 60 to 75, your monthly expense should not be more than 0.5% of the liquidity corpus. After 75, you could go up to all the way up to 1% of your liquidity corpus. I mean, the last slide. What do I, what is my advice for senior citizens, right? First, all of us have multiple bank accounts when we are young, but as we grow old, try and reduce the number of financial relationships you have, because having with one person makes your relationship important to that bank, right? Have one savings account, try and keep the FDs in the same account, have one health insurance policy, and ideally one mutual fund, not more than that. In your accounts, especially if you're of a higher age group, try and make, definitely put nominees, but more importantly, if possible, if you have a trustworthy relative, make them joint account holders, so that in any eventuality you are not available, you are unable to operate your account, they are able to operate the account. So try and make close family members, a spouse, or a younger child, or a grandchild, your joint account holder. Always have a list of assets, and for each of these assets, whether it's a mutual fund, whether it is a real estate, whether it is a car, try and put the name of a person who should be called in case there is a liquidation that is required very quickly for various medical emergencies or any kind of situation. Lastly, make a will. Now, what you should not do, right? And when I say insurance policy here, I don't mean health insurance policy. I'm sorry, I should have added that. Don't buy a life insurance policy. The most commonly missold financial product to the elderly today, and this happened to my father. HDFC Bank was trying to, Kotak Bank was trying to sell this to my father, trying and selling a 5 lakh rupee annual premium insurance policy, claiming that you will get 5 lakhs after 1 year, after 10 years, all that. Don't buy a life insurance policy. Life insurance is not an investment instrument. It is not recommended to buy life insurance after you have no dependents who are dependent on your insurance payout. Do not buy life insurance policy. My another strong advice, I have seen people suffer from this, is do not invest in stocks directly or day trade from your corpus. There is a temptation to do a lot of day trading because it looks like easy money. If you have surplus beyond your corpus, required corpus, go ahead. It's also entertaining. But if you're drawing down from your corpus and thinking that you're going to grow your corpus by doing day trading, stock trading, these are very difficult areas to make money. And if you're a new person, you will not be able to make supernormal profits. Lastly, when you are doing any of your, whether it is senior citizen savings scheme, FDs, everything, have a trusted family member advise you or be with you when the bankers discuss. And lastly, remember, as you age, yield, that is earning something every month, is most important. It is not the long-term return that is important. If somebody is trying to tell you about long-term return, please ask them what is a monthly investment that comes, right? Just to wrap this up, there are a lot of frauds, and the best way to handle fraud is to remember yourself that there is no free lunch. There is a very good economic paradigm that nothing comes free. If somebody is trying to sell some atrocious return or trying to sell you a very high return or trying to sell you a scheme, be aware that there is a catch. There is never anything. Today, fixed income, 8 to 9, 10% is standard return. Equity, if you invest, 12 to 13% is standard return. If somebody is promising you return more than this, there is some catch. Be aware of that catch. Investing in insurance, like I told you, having wrong FDs, having FDs for 5 years, 10 years. Sometimes people take 10-year FDs. Having FDs in cooperatives, making illiquid investments, right? Buying real estate where the title is not clear. You can do it when you're young, right? You may get a discount for buying real estate that title is not clear. But as you grow old, be aware that it is more important to have liquidity. Having an asset which is illiquid is as good as having no asset. With this, I kind of wrap this up. There were a few questions that Mr. Jambunathan had addressed. I'll try and quickly answer them, but I also want to leave some time for any other questions that may come. So one of the questions that Mr. Jambunathan posed was long-term care. How does one manage in the eventuality of long-term care? How does one manage it? Honestly, my understanding of doing this in my own personal ecosystem with grandparents and in association with Dr. Vijay Kumar, who's part of NIMHANS, is long-term care outside is very, very expensive. Works best at home. And it is important that as the elderly, while your children may not expect it or the caretaker may not expect it, there is a loss of earning for whoever is doing the taking care, right? If it's a family member, great. But if it's an outsider, it's a significant time investment. Try and figure out a way to compensate the caregiver through monthly earnings and asset transfers. At the same time, this is a very difficult suggestion to make, but have an honest conversation with your children, with your grandchildren, and have a deliberate conversation and be very clear on what your expectations are for long-term care and life support. So in an eventuality that it comes, how long do you expect this long-term care to be given to you? How long do you expect life support to give? It should not happen that in taking care of one spouse, all the savings for the other spouse is taken away. So these are difficult decisions, and it is impossible for the caregiver to make it when you are not able to make this choice for them. So whatever your choice is, it is important that you discuss this with your family members. Another piece of advice which I feel important to give to my older generation of my parents, because I see it in my own family, is as we prosper as a country, the inheritance that you people are going to make for your children may not be that relevant, because as we age, right, our parents are living till 80, 85, 90, and God, hopefully even more. Even the children age, and that inheritance may not have much value. It may be more valuable to give it to your grandchildren or give it to anybody else who you think is important, who will value this inheritance. Because as children age, as they cross an age of 50, 60, the money becomes less important to them because they've also crossed the stage where they are going to be big beneficiaries of getting money or some other property. So it's as you are aging and as your children are aging, it is a good thought to see whether you can bequeath some much earlier, right? Depends on your personal situation, but it may be a good thought to bequeath it earlier. It may also be a good thought to consider giving it to your grandchildren, because they are likely to value that and see more merit in that. The other question that comes up is, in old age, how do I earn? If other than, what are the options? I told you in the previous one that please avoid doing stock trading. What you have to remember, and this is one of the critical things I see with my own parents and with the larger ecosystem, is that there are a lot of skills that a lot of you possess, and mostly it is not, you are not able to monetize it because people don't realize that you are looking at a monetary value. People are looking to benefit from that skills. But if you really want to, if you are in need of money, you should start putting a value to that skills. And there you'll be surprised to know that a lot of people will be willing to pay. Today is the age where people are willing to pay for any skill that they learn. And classical things that I've seen younger generation benefit from olders is in terms of English, native language speaking, writing, traditional medicines. All of this may seem like free, right? But it has a lot of value. People assume that you may not need that money. But if you are in need of that money, it may be useful to call that out. And in this day and age, what is called as, the gig worker generation, it is not uncommon for people to pay for whatever the service that they seek. Yeah. And lastly, as your children and grandchildren get good education, all of us, I'm sure I can connect this to my parents. Frugality was an important virtue. Our parents grew up in a very tough economic environment, and frugality is built into their DNA. But you have to remember that as your children and grandchildren get good education, prosperity is going to be far more common, right? And hence, I reiterate the point I made earlier. Inheritance may not be as important as you think it is. So, use the extra money if you have to live your life comfortably. You're better off taking a good cab, taking a good bus, taking an aircraft and spending that money rather than, planning for inheritance. Yeah, that is I think I've overshot by a little bit, but I hope it has been useful. Please feel free to use the last 15 minutes for any questions. And I apologize once again for the glitch in terms of internet connectivity.
Thank you very much, sir. See, what is that you and I can do for the internet? Tell me, sir. See, let us not get into that. See, thanks for a very interesting session, sir. See, in fact, we have given lots of, take-home points, sir. So, this is one area where I think people differ from one person to another, and the needs of the senior citizen are also different, sir, at different points of time. And we have got a different, set of seniors, whose income streams are different. So in that context, balancing all their needs is quite difficult. But you have done a very beautiful job in the sense that you have balanced all their needs and given very good advice, sir. Before proceeding further, I would like you to talk to me, elaborate a little on this super top-up plans of insurance companies. Because this is something, I have also come across this. Even in our group insurance scheme, we are talking about the super top-up scheme, etc. But I really do not know how it operates and what is the cost for this. See, ultimately, everything depends on the cost, sir.
Yes. So super top-up schemes are normally much cheaper than the regular insurance schemes. Of course, for a younger age group. But for an older age group, even for an older age group, they're cheaper than a regular insurance. So the way a super top-up works is either super top-up is taken on your existing insurance scheme. So for example, let's say your existing insurance scheme covers up to 5 lakhs. So you can take a super top-up from 5 to 30 lakhs. So what it means is the first 5 lakhs is covered by your existing insurance. If you have, God forbid, have an illness that costs you a lot of money, only then will the next insurance plan kick in. So because you have a first insurance, they're normally more, they make the insurance plan a little more easy, because they don't do the normal checkups and all that, because they know that they're not covering the first 5 lakhs. In some other cases where you don't have an existing insurance, you can take the first 5 lakhs. So, or first 2 lakhs. So what you, a common super top up is called a 220 plan, where till 2 lakhs you cover, from 2 to 20, the insurance company covers, right? There are 440, there are 450, these kind of plans. So the first number, which is the deductible, so the first 2 lakhs, the insurance company will not cover. So let's say you have an illness and your hospital bill comes to 1 lakh, they will not cover. Let's say in the same year you have a second illness. Now the hospital bill comes to 3 lakhs. So they will cover the first 1 lakh, the next 2 lakhs, because your insurance limit has now expired, the next 2 lakhs has to be covered by the insurance company. Let's say you have no insurance, right? The first 2 lakhs you have to pay, anything about 2 lakhs will be covered by the insurance company. The premium normally for an elderly age group will not be more than 10 to 15,000 rupees for a 220 kind of plan, because the insurance companies does not see this as a common event. It only happens if somebody has an illness that has a substantial expenditure. So super top-up plans are common in countries where basic insurance or basic healthcare is given, and you need insurance support when there is an extraordinarily expensive illness. So the idea is your normal, small operation, this, that gets covered by a normal insurance company or from your pocket. But let's say, there is an illness that costs you 25 lakhs, that the insurance company covers.
How costly is the premium, sir, for that? Any idea?
Like I told you, I don't think I have to check. I can send you by message what it is for this particular age group, but it won't be more than 10,000, 15,000 rupees is my understanding.
That's a very good news, sir. In fact, it will be very useful to many of the senior citizens, because we normally avoid the super top-up because we do not know what exactly it means. Many of us, some of us know that. So again,
yes, so super top-up will only come in handy when you have an illness that is very expensive to take care of. Normal insurance.
That is the exact thing we are trying to cover. See, we are trying to cover an illness that which is going to cost us very much high. The normal insurance premium or normal things we can always pay. Supposing
exactly.
That's this contingency that needs to be covered in the senior citizens.
Exactly.
So, incidentally, Mr. Narasimhan has asked one question in the chat box, sir. Yeah. He said, sir, the interest earned on National Savings Scheme 1984, maintained in post offices, was exempt from taxes when earned. Deposit into the account is now since stopped, sir. But tax when withdrawn along with the principal as per the original rule. No change has been notified in the rules, sir. But from last financial year 2021-22, the interest earned is included as income by the CBDT AIS. This amount is also taxed at the time of withdrawal. This leads to double taxation. Some accuse the same treatment for PPF also. But our PPF, it's not happening, sir. Okay. Now there is no provision for representation to IT. What is the solution?
Honestly, I'm not a taxation expert. I can check with somebody and come back. I really don't have a specific answer to this, but I can check and come back, sir. I'm not.
Yeah, that will be very nice, sir, because of course many of us, we have all withdrawn the money from this old National Savings Scheme, NIS. Because once they thought that they are going to tax it, then we have withdrawn. But some people have still kept it there because if I withdraw, I need to pay tax. So to avoid that, some people have still kept it there, sir.
I will check this and send you a written reply, sir.
That will be excellent information for all of us, sir. So now the floor is open. Any other person would like to ask any other thing, sir?
I can see Mr. Ramnath has raised his hand. He may want.
Who has raised, sir?
Mr. Ramnath.
Okay, Ramnath, please go ahead.
You'll have to unmute, sir.
Ramnath, unmute.
Hello, sir. Good evening, everybody.
Ah.
Regarding the insurance, that is health insurance, even though the premium also high, if you go to the hospital, they will charge very exorbitant rate. So what is the thing cost? How much we can reduce the cost? We even after taking insurance premium. Please explain, sir.
Yes.
Can you
So,
understand?
yeah, sorry, sir. Continue.
Hello. Hello.
Continue. You're asking something.
Over, Ramna.
Hello.
Ah,
No,
go
no, no.
ahead. Go
Regarding insurance, we are paying premium. That's also on higher side. But in the hospital also, they are charging more rate than the ordinary one. Charging to people, room rent or medicine or consultation, etc. Any idea of reducing our premium in
So
our health insurance, sir?
yeah, the only potential way to reduce premium is to get into some kind of group bargaining. And I have seen some banks and public sector organizations able to do this as a group when they do it with their insurance.
But okay, sir, that is a tie-up. Tie-up also, but at least for one day will continue. But the insurance and the customer will continue forever. For next year, we'll go, no, you are not tie-up with the other company. Please go to some other company, some other bank, what they are telling. That's also some banks also only, some banks are accepting that insurance premium. This company will not accept, this company we don't accept, like that. So what is the
I agree, and I honestly don't have a solution for it. I think why I proposed super top up was basically to take care of very large expenses. Other than that, you have a choice of trying to go out of pocket. So for a small amount, you have a choice of using your own money, stopping, having the 2 lakhs, first 2 lakhs paid from out of pocket, and only do super top up and save the premium. But then you run that risk that up to 2 lakhs, it will go out of your pocket. Of course, when it goes out of your pocket, you may have some negotiating power, but in an emergency, I would still recommend at an older age group, if you have an insurance policy, keep it. Yes, there is expenses over and above the insurance policy, but I don't think there is a way out without spending on this. So keep your savings for the expenses.
Okay, thank you. Thank you.
So ultimately, nothing is equal to our savings, sir.
Yes.
And you can also elaborate something about this bills, sir. See, many of us have not gone in for the exhibition of bill and how important bills are. See, most of them think that it's okay, I have done a nomination, that is sufficient, etc. But they are totally different, nomination and bill. I mean, purpose is totally different. And bill is the best form to transfer money from a person to his legal hands.
Yes.
Not to anybody of his choice.
Yeah.
So I think kindly go ahead on that, sir.
Yeah. So on nomination, what you have to remember is that just because a person is a nominee doesn't mean that he's an automatic inheritor. And in a lot of assets, unless you make a will, right, including a bank account, if it is unclear to the bank, like a mutual fund or various other assets, if it's unclear on who are the inheritors, the concerned organization may slow down the process. So advantage of making a will is, while you may have a nominee, if the will is made into different name, it's a nominee's responsibility to ensure that the assets is shared as per the will that is made. Right. So it is, like I said, in a bank account, especially your operating bank accounts, my strong recommendation is have family members, spouses, or children as a joint account holder. Just add them as a joint account holder. So in an eventuality where you are unable to operate the account, they can operate the account on your behalf. They don't have to wait for execution of, the will, etc., before the bank account becomes operational. Right. And they can use that money for whatever the purposes, especially in a medical emergency if they need that.
So Tangaraju would like to ask any questions, sir? Hello.
Yeah, Mr. Narasimhan is asking, what are the present rules on capital gains scheme? Is it operative? What are the instruments? Yes, capital gains is operative. If you are earning capital gains through real estate investments, you have to reinvest in real estate. So if you are earning capital gains up to 50 lakhs, you can save on the capital gains by investing in rural electrification fund bonds, but they give you only 5% return, but you will save on paying tax to the government, which is around 23%. So beyond 50 lakhs, you have to reinvest. Like I was telling you, and like I've told my parents and my in-laws, at an older age, you are better off paying the capital gains of 20% and putting the remaining, if you have a significant investment corpus or not a significant corpus, better off putting that in a fixed income instrument so that the other 80% earns interest for you rather than reinvesting in property. Of course, if you feel that you want to reinvest in property and you have sufficient surplus, you can go ahead and save capital gains by putting in reinvestment. The other part of capital gains is on financial instruments like equity and debt. I'm assuming that if you're less than 7 lakhs of your annual income is less than 7 lakhs, which is largely the case for most pensioners and interest earners, there will be no capital gains because all capital gains is included in the income. So if your income, whether it is through capital gains, whether it is through interest, whether it is through pension, if it is within 7.5 lakhs for one individual, you will not be taxed.
So that's the advantage in going to the new system.
New system, and ideally dividing your corpus between the spouses. So because of some of the schemes, try and split the money that you're putting in FDs between both the spouses and other relatives who are, possibly not earning other incomes.
And who are also reliable, sir. Ultimately, the money should come to us.
Yes.
That is, see, this is one more. See, this is, Mr. Tangaraj has asked one important question, sir. See, he is asking, which instrument is safe for deposit with higher interest for CDS?
Yeah.
Monitoring institutions are not fully watching shell companies which are cheating people, investing huge money for higher interest. Deposit amount are not reserved on later date. How to educate investors?
Yeah, I think as you move into senior living, one of the every year without fail, the government has always had one flagship investment program every year. Currently, it is a senior citizen savings scheme. Usually, this flagship scheme will have the highest interest rate, and they will make it easy from a taxation perspective. So always benefit from whatever is the, earlier there was a Pradhan Mantri PMAYVY, right? So that scheme was there. So that was allowing through LIC up to 15 lakhs. So they will come out with a scheme every year. Try and keep money in one of these schemes because this has the highest interest and it is meant for senior citizens. The second, I would say, a safe investment, please don't get into debt mutual funds and all that unless you've done it in the past. The second one is to do it in FDs. Pick any private bank or government bank. I think most banks in India up to 5 lakhs are anyway safe because guaranteed by the RBI. Even above 5 lakhs, I would think most banks are safe. If you're very concerned, try and split between multiple banks. Keep 5 lakhs in each bank. So that, even if there's a problem, the RBI is guaranteeing up to 5 lakhs. Because senior citizens get a 1% extra, sometimes 0.5% extra, that benefits. And because a lot of them are not tax paying if you give 15H, I would still recommend sticking to FDs. If you want to have other kinds of income, go to annuity plans. Every insurance company has annuity plans, including LIC has it. But you can try out SBI, you can try out HDFC, you can try out ICICI. Annuity plans are of two ways. One is return of principal. Second is without return of principal. Now, depending on your family situation, depending on your personal need, if immediate requirement of money is more important, do an annuity plan without return of capital so that you only get annuity till your lifetime. The money that you invested will not come back to anybody. But if your personal situation is good, if you have a good corpus, do an annuity plan with return of capital. Without return of capital, even today, you get annuities of up to 9% to 10% every year. And these are joint life. So if any of the spouses are alive, they will continue to pay the annuity. If you do without return on with return on capital, that is the money comes back to your nominee, then you will get 6 to 7%. Only after these three, I would recommend you to look at what is called as balanced fund. Balanced mutual funds have a mix of equity and debt. That is the fourth option you can explore. especially if you are at an age of 60 to 75. I would say above 75, stick to the first three. If you're at a slightly younger age group, want to have some benefit of extra return that comes from equity, try balanced equity fund, balanced mutual funds. Balanced mutual funds usually give 10 to 12% kind of returns. Of course, they have the risk because sometimes 40-50% of the money in balanced equity fund is in equity. So equity can go up and down. But if you're at a younger age group, relatively younger age group of, I would say within 70, I would recommend at least 25% of your money can go into balanced equity funds. I hope I answered the question on where to invest.
Yeah, so you have done it very well, sir. See, only thing is, the senior citizen, one more thing I will add to Mr. Tangaraj is that the senior citizen should listen to these advisors. See, they should not be, even at the beginning, Samit Saab was very clear about one thing. See, don't be bothered only about the return. If somebody is promising you a high return, please note that your capital is under risk. There is no free lunch. But he has right at the beginning, he was told. I think we need to follow that advice. And if somebody is going to promise us something out of, which is not there normally, then we need to think thrice before putting money there. And even if somebody does it, my advice is that say, okay, manage with try your luck for 1% or 2% of your capital. The rest of the 98% of the capital, you keep it safe. Yeah. So 1 or 2%, 1% or 2% of your capital, if you just try this, if you are getting money, it is fine. If you don't get money, also it is fine. Ultimately, you are not lost much. You will not know.
See, it is not at all advisable for 1% extra interest rate to risk 100% of capital.
Exactly.
Full deposit money is not returned by companies, including LIC of India. The money is they have deposited in some share market. The money is fluctuating. They are telling if I deposit 50,000, they are saying only 40,000 now. After deducting all service charges and other things, when I need to get refund, they are not even refund full deposit amount. Yes, SBI life insurance.
So, Mr. Tangaraj, one of the it's a very good thing you're talking about it. One of the most mis-sold products in India is insurance, especially to senior citizens. Right? They call it like deposit, but it's actually insurance. And insurance is never a guaranteed return. Yes. FD is guaranteed return. If you put money in FD, if you go to a bank and say, I want a fixed deposit, the bank is obliged to give you the fixed deposit. But insurance is never guaranteed returns. They only show some Excel sheet, some spreadsheet about returns. I told the example recently, my father withdrew his PPF money in State Bank of India. The State Bank of India manager referred him to some colleague or her in Kotak Bank, and that person came to my parents' house to sell insurance, which was a 5 lakh premium every year for the next 5 years. And my father is 79 years old. Right. So I got really upset with that person. I said, what are you trying to sell? This person is 79. Insurance is for who? He needs money to use every day. You are selling him insurance. So no, and my father was convinced till I had to go to his house and say, don't do this. Because they will say, no, you'll get a higher return, after 5 years, you'll get this. And people get very easily convinced. So insurance, if there is a name insurance at an older age, don't do it. Instead of that, with insurance companies, you can do what is called as annuity. If you go to LIC, you tell, I will give you a corpus. I don't need a corpus. I will give you a corpus. You pay me out monthly returns. Yes. And give me a fixed return.
Yes, you have very well said, sir.
Incidentally, Mr. Jammunathan, I am not I'm not in the mutual fund or insurance industry. But if any of you at any point of time need specific advice, right, on which mutual funds or which insurance is good and all that, I have my own financial advisor who I use for my investments. I can ask him to come and speak on my behalf, because I am, the specifics of which mutual fund to do and all that, I use an advisor.
Correct, sir. Correct, sir. I understand the point, sir. See, the problem is that, okay, see, here also in Vayomanasa Sanjeevani, in our webinars, we do one thing, sir. We are very, very clear about this. We don't endorse any product. We don't suggest any product to anybody. Yeah. We just give advices. In fact, we get experts like you. In fact, today we have Vayomanasa Sanjeevani has realized the importance of finance in good health. For keeping good health in a senior, what an important point finance is playing. That is why very rarely we get a financial expert to come and talk on this. Normally we get people only from the health business, not from health. I should not use the word business because they are all experts in the particular field. They are all working for NIMHANS or an organization like that. They have nothing, no product to endorse or nothing to sell. They just give their ideas, they give their knowledge. And we cannot also expect whatever they have learned in 10 years, they should translate to us, transfer it to us in 1 hour. It is not possible. So we get some bird's eye view about things. So thank you very much for that. Sir, any other questions?
My suggestion is not to the post office senior citizen is very good because we don't lose our principal deposit amount. We will get
Incidentally, there is a
interest.
post office monthly income scheme, which is a
Yes.
good scheme. The only
monthly
problem with the
income,
post
MIS.
office is it is a little inconvenient. Otherwise, it's a good scheme.
MIS is very good, sir, as far as my
Yes.
concern. And senior citizen also, they are giving a quarterly interest or monthly interest, whichever we like. But principal deposit amount is safe. That is my directing.
No, you're right. Post office monthly income scheme, which is POMIS, is a good scheme. I think there is a limit of around 5 or 7 lakhs.
10 lakhs, I think.
10 lakhs.
Now that
And you can do it. But off late, I find the senior citizen savings scheme, which is 30 lakhs per senior citizen. And the current interest rate is 8.2%.
8.2%.
Yeah, your suggestion is
It's a good
spouse,
scheme.
we can open 2 accounts. Your suggestion
Yes.
very good. Because we depend, our spouse can open one deposit and husband or wife like that. Both
Yes, almost
50
60 lakhs you can manage a husband and wife, and it's a
Yes.
significant earning. 60 lakhs
Very
can
good
earn you at
advice,
least
sir. Very good
40,000 rupees a
advice,
month.
sir. Because most of the people are not depositing in the spouse name. This message is very useful to our senior citizens. Very kind of you, sir. Thank you very much.
Thank you.
Sir,
If there are any more questions, I can take them, separately. I will respond to that one on taxation later. Anything else, sir?
I think, Ramnath, you like to talk anything? I think if there is no other questions, I think, this is time for us because we have already overshot.
Question, Jamanathan.
Yeah. Tell me, sir. Please. Go ahead, sir. Go ahead. Manjunath, sir. Go.
Your opinion on investment in national pension fund, a national pension scheme, no? I don't know whether you already touched upon it. I joined the session.
I did not touch upon it. I don't think for an older citizen, national pension scheme is a good scheme. I think they have annuity systems like other, I talked about insurance companies like ICICI, LIC, SBI, all of them have annuity schemes. Even National Pension Scheme has an annuity scheme, but for that you have to create the corpus in the NPS. So National Pension Scheme, I would not recommend for senior citizens. I think if you're an earning member and want to save from taxes, it has some benefits. The annuity scheme is comparable. It is not a bad annuity scheme. It is comparable to the annuity scheme of insurance company. So it is equivalent to any other insurance company in terms of annuity schemes. The advantage with an insurance company, sir, is that they have this annuity scheme without return on principal, which is very unique. Only insurance companies can provide it, which depending on every person's situation, right? You may not want the capital back. If me and my spouse are gone, I don't want the capital. I want more money every month. So insurance companies can provide that scheme. So they have this scheme called without return on principal, where the principal doesn't come back, but they will pay higher interest, extra interest. And if you're going to live for 25 years, it will benefit you more than getting the principal back.
Okay. Thank you. Thank you so much.
You're welcome, sir.
Any other person like to ask any other thing? I think there are no further questions. And Mr. Samit is also a very busy person. He cannot hold on to him like this for a long time as well. Therefore, my one final remarks I may like to say, I thank you very much, sir, for sharing a very insightful knowledge on these finance matters, especially for seniors. There are many take-home points in today's session, sir. See, especially on insurance and these, the annuity schemes, and with return of capital and without return of capital. These are all things that people do not normally easily understand, sir. So you made it very lucid because probably your qualification in MBA has made us to understand things, made you to explain things in a way in which these people like us also can understand, which we do not have much knowledge on finance. Even we could understand. So thank you very much for a very, very lucid presentation, sir. Just I wanted to add one thing, sir. See, Vayomanasa Sanjeevani has been established as an outreach arm of Geriatric Department of National Institute of Health and Geriatrics, Bangalore, shortly known as NIMHANS. The team of dedicated students and volunteers and staff under the leadership of Dr. P.T. Sivakumar, head of Geriatric Department, are reaching out to elders at their place of stay in like old age homes, senior citizens colonies, etc. So these webinars, see, this is an outreach program. These webinars are organized every alternate Monday in English to enable senior citizens to understand how a senior can remain active and enjoy his life, especially while at the same time contributing to society as well. So I request all of you to join such webinars and be benefited. And you know, one of my message is that please try to tell this to your friends and your groups so that more and more people can join, because these seminars are all conducted at a huge cost. And this cost is being introduced by NIMHANS. NIMHANS is an all India organization and they have nothing to sell. They are not endorsing any products. They are just giving us knowledge. My request is that please let us all learn. And especially people like Mr. Samit, who are highly educated and who can just give us knowledge. This kind of knowledge, unbiased knowledge, we normally do not get everywhere. Therefore, my request is that please use this. Thank you, sir. Thank you very much. See, only thing, for all the good things that you have done to us, sir, Mr. Samit sir, what we can say is we can pray God to shower on you all that are the best in life and give you more and more energy so that you can address people like us, sir. Thank you.
That is the most important, sir. Thank you very much.
So on behalf of VMS Vayomanasa Sanjeevani, my heartfelt thanks to Mr. Samit Reddy, sir. Thank you for your valuable presentation today, which makes our senior citizen to have a light on this topic today. Thank you so much, sir.
I can share the presentation to Mr. Jambunathan. Anybody wants to see it later, feel free.
Yeah, it is like YouTube live, sir. So it has been
on YouTube live. Sir.
Okay. Thank you very much.
Thank you, Jambunathan sir, for moderating the session, who is a senior manager, retired manager from State Bank of India. Thank you so much, sir, for patiently coordinating this session, a great event. Thank you so much, sir. I also extend my thanks to our YouTube and Zoom participants. As sir has explained, please share this knowledge or share this Vayomanasa Sanjeevani program to various senior citizens, so that they can be benefited from their doorstep. Thank you so much. I also extend my thanks to our partners with VMS, Government of Karnataka, Indian Psychiatric Society Karnataka Chapter, Karnataka State Legal Service Authority, Bangalore Apartment Federation, Happy 60+, Samadhana Counseling Center, Icon Life Sciences, REC Foundation and NSC Foundation. Have a cheerful evening. Thank you once again. Thank you all.
Thank you, ma'am. Thank you. God bless all of you, ma'am. Thank you.